Hello, welcome. Why do we need financial advisors? And why do we pay financial advisors so much of our hard-earned retirement money? The availability of free, credible information sources has never been greater than it is today. Yet for some reason, many people, especially the baby boomer generation, like my parents, and many parents of friends and family I know, seem to think they are too ill-informed to take charge over their retirement funds. Today I'm going to challenge this idea with some serious questions for everyone to consider, whether you are at or approaching retirement age or even 40 years away from it. What I discuss today is truly important for everyone to consider. So let's get into it. So why do you need to pay attention to this video? I'm going to start with a personal story to illustrate why. I come from an average middle-class family, grew up in the suburbs. Both of my parents worked hard to provide for me and my siblings. My father worked for the same company for over 40 years and continues to work into his 70s today. Not to be rich, but simply to live a peaceful and modest life. My mother also worked full-time for most of my childhood school-age years and continued well after I moved out of the family home. They've never really wanted for much, especially luxurious or opulent things. They instead chose to save and put money away for their retirement. So what are they doing today? Now, as empty nesters, both of my parents passed retirement age many years ago. They have retirement savings invested according to their own choices, and they hope that they will have enough to provide a nice life during their golden years. Sadly, even though they are both very smart, educated, more than capable, and also disciplined people, up until recently, they chose to give away the majority of their retirement money decisions to a financial advisor. And they did so for over 20 years. Why did they do that? Mostly because they worked so hard for their entire lives and never really had time or really had access to trustworthy financial education. But more than that, they feared what could happen to their future little nest egg and did not want to risk losing it because they alone had made a bad decision. So it was down to a combination of fear and a lack of financial education which drove them. They felt they were not really able to transfer the skills they developed in life to confidently make their own financial decisions because, like many, they thought big financial decisions are risky and scary and far too complicated for them to truly take charge of. And what was the consequence of this decision for my parents? I will show you shortly, so stick around. But first, what do I think my parents and many families like them should do instead? Firstly, I think it's time to spread the word that not trusting yourself to make these decisions is nonsense for most people today. So get the heck out of here with this self-doubt. This type of thinking had disastrous consequences for my parents and continues to have disastrous consequences for so many families today. Unfortunately, come retirement day, you are likely to find a lot less in your pension pot than you hoped for. Now, why do I say that? Across most major countries like the USA, Canada, the UK, and Australia, the average financial advisor charges both an upfront and ongoing annual fees, which is fine in some cases, but the devil really is in the details here. And can you guess why? The reason is when these fees are charged as a percentage of your portfolio, or otherwise known as based on assets under management, then keep watching, as you're going to be blown away at how those fees kill your returns and therefore your retirement funds. So I'll show you some data shortly. But first, generally, the ongoing annual fees from many advisors range from what sounds like a tiny 0.5% to 1.5%, and occasionally up to maybe 2.5% or more, with the higher fee being more common just in your first year when making an initial investment, as advisors justify the higher fee by providing a nice, glossy plan for you. Sadly, this is precisely at the time when you want your portfolio to be starting with as much capital as possible, and they take more out of it. Then as part of their ongoing fee service, they offer you things like to call them whenever you like throughout the year. They will rebalance your portfolio each year to justify their fees and blah, 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 blah. But what does this actually mean? And are you actually getting fair value in services? And most importantly, in returns for the fees paid? Firstly, most people, just like my parents, never actually call their financial advisor each year. So you aren't receiving value for this service. But what other services are there? Surely they pick better investments, right? Before we get into that, let's assess what the true cost of fees based on a percentage of portfolio is. Now, thank goodness my parents no longer utilize the services of their financial advisor because of this juicy fee structure. But unfortunately, they did so for about 20 years. So what happened? It's actually quite devastating. Please look at these tables. When you compound a return at 10%, a reasonable average long-term return over 30 years, versus a return less a financial advisor's average fees, you will see what happens. Let me explain what you see here. The table on the left assumes you or your employer are investing about $1,000 each month in your pension. And on the right, about $2,000 a month over 10, 15, 20, 25, and 30 years. Now you can see the impact on your capital of having a 1%, 1.5%, or 2% little juicy fee taken from your returns each year. Then in red, it shows this is effectively what you are therefore paying your financial advisor on average each year. Now look at how big the negative impact grows to as time passes or your pension grows. If you stay with an advisor for 30 years and pay just 1%, are you really getting $500,000 to $1 million of value for their services? You want to know the worst part, which you will see in the charts I show you shortly? For the $430,000 you pay away over those 30 years, that equates to 19% off what you would have had in your portfolio, because your portfolio only would have grown to 2.3 million based on these rough estimates. So if we ignore the precise numbers, the table also shows that as your capital doubles, the fee in real money paid to your financial advisor also doubles. Obviously, that's how percentages works. So the key question to ask yourself is, does the value received from the financial advisor double? So should somebody with a $4 million portfolio pay double that of someone with a $2 million portfolio? Furthermore, the tables show, moving left to right, as the fee increases by what sounds like such a minuscule amount of 0.5%, due to the magic of compounding, it actually creates a significant amount of capital loss. So whether you have a small amount in your pension, and certainly if you have $1 million or more, then there are serious questions to ask in terms of paying a percentage fee, even a tiny percentage. Now, as you can see, that even at the smallest end of my example, you are still effectively paying over $1,000 per year over the first 10 years, which then becomes $5,000 per year, backdated, after 20 years, and it blows out to $15,000 effectively paid each year after 30 years. That's backdated, because in the final years, the amount taken by the percentage is so large. So is it worth the $430,000, effectively $15,000 a year over 30 years? Another way to look at it is simply based on the amount you have in your pension. See this table? Do you pay your accountant that much each year? If not, then please reconsider how much you pay your financial advisor. This is an annual fee. So every year your portfolio value is this big, you pay away this much in real terms. So if you're lucky enough to have 5 million invested in your retirement, do you really want to pay away an entire, let's say, luxury car in fees each year? Check out these charts to show how the impact grows as the size of your portfolio grows, and therefore how much worse this impact is for most of us in our final years as we build the most in our pensions. First chart, $1,000 per month at 1% annual fee to the advisor. Second chart moves to 1.5% annual fee. Third chart shows 2% annual fee. Now we switch to $2,000 per month being saved for retirement at 1%, then 1.5%, and then 2%. Now it is very important I highlight that my examples make a huge assumption. Have you realized what that assumption is? I am assuming you will make identical investment decisions and therefore achieve identical investment returns under both scenarios. A scenario where you are guided by a financial advisor that's taking a percentage fee, and a scenario where you are not. So is that a fair assumption? Most financial advisors who wish to take a percentage fee from you will likely sell you on the possible outcome that they will be able to pick much better investments for you and therefore improve your returns far beyond their tiny, tiny little fees. Now, should you believe them? Well, if they have a time machine or a crystal ball, then yes. Otherwise, while their hypothetical prediction of getting you better returns could certainly be true, the only question you should ask is it likely to be true? Now, I propose it is unlikely to be consistently true, and sadly it is more likely you're depriving your future self of a larger pension and therefore also depriving your children of their possible inheritance. So why do I question your advisor's prediction? Firstly, many financial advisors recommend managed funds for you so you can achieve your returns, as many advisors get juicy little commissions for investing your money in managed funds. Of course, they would argue they are choosing the right funds that align with your risk profile, which they typically determine through a risk assessment and often are mandated to do so by law, which generally becomes as simple as taking your age and turning that into a percentage and then using that percentage as the amount to go into fixed income investments. Meaning at age 50, 50% of your portfolio should be in fixed income, and at age 60, then 60% of your portfolio should be in fixed income or interest-bearing investments. I'm simplifying their process significantly here, but not entirely, as on average, this is how it works out. And why else do I challenge their prediction? Well, and this is maybe the biggest issue. Typically, those managed funds that advisors recommend have their own juicy percentage fees, which are also around the same level of 0.5% to 2%, and occasionally even higher. So therefore, you can now go back and double all the amounts that I showed in my tables and charts above. And kaboom, bye-bye pension, you've now just lost twice as much as my estimates showed. Yay! Now that's sarcasm, to be clear, but this is definitely no joking matter. Truly a disaster which has affected and continues to affect millions of families all over the world. Hence the need for this message to reach as far as possible. But am I being fair with my message so far? I do not want to be all doom and gloom. Many financial advisors offer valuable advice on effective tax planning, risk minimization, investment options, etc., etc. So, what is my message then? My key message is, if you feel you need a financial advisor because your investment plan is quite complex with various companies and different income streams and all over the place, or you're just too busy to learn the basics of what you would need to know, or you truly think your financial advisor will get you a consistently better return, or finally, you just want to be sure that you've ticked all your boxes, then go right ahead. But make sure you find a good financial advisor. And by good, I mostly mean one that will happily offer their advice with a fee-for-service structure, just like an accountant. What does that mean? It's in the name. You simply pay them by the hour. Now, please do not be fooled by the flat fee once per year fee structure many try to offer nowadays, which often adds up to many thousands or tens of thousands as a one-off flat fee each year, all encompassing. I'm not a supporter of this single large annual flat fee structure either. So if your chosen advisor does not offer you the ability to pay by the hour, and equally important that their hourly fee is reasonable, similar to that of a good accountant in your city, then I strongly think you consider finding another advisor. I have a no greedy advisor policy. Now, when should you go see a financial advisor? Well, how long is a piece of string? Nobody can see the future. But what can be valuable and worth paying your advisor for every year or every few years, even for just a 15 or 30-minute phone call, is to check on the law and tax changes that you could take advantage of. Although a good accountant may be able to advise you on many of these changes, or just check your government's websites, or even YouTube is full of great free help. That said, if you do have a relationship with a good financial advisor, then they will likely send out an email newsletter each month or let's say every quarter, keeping you up to date on these changes and prompting you to think about, perhaps put in a quick call when you feel it is necessary. And what questions should you not pay your financial advisor for? I would not waste much time discussing when the next market crash will arrive or how much the market will go up this year, as these questions are tough to answer. So don't waste your children's precious inheritance on such questions. Now, how do I suggest the majority of my family and friends invest their pension? Very similar to how I suggested in my earlier video. Click here to watch that. First, I suggest they set up a tax-effective structure in whichever country they are tax resident. So a 401k, an IRA or Roth IRA in the USA, a SIP or an ISA in the UK, a self-managed super fund in Australia. Then what do they do with that tax-effective structure? Invest just like Warren Buffett suggests, and how I highlighted in my previous video. Don't make it complicated. Most average families can follow this strategy. Invest regularly into a broadly diversified, low fee fund like an S&P 500 index tracker or equivalent, ideally adding more during 20% or more market downturns. Of course, factoring in your home currency and how many years they are from retirement. And what should they consider as they approach retirement? Once they're around 10 years away from wanting to draw on their retirement funds, it certainly starts to make sense to ensure they create around 2 years of estimated living expenses in fixed income or liquid investments so it's ready to be drawn down. Then, as their chosen retirement date is just a few years away, consider increasing this amount to say 4 years. And if they want to be really conservative, then as much as 8 years of expected living expenses in fixed income type investments. So it's ready to draw. And any capital beyond their chosen liquidity or readily accessible amount is probably better off remaining in growth investments like the S&P 500, real estate, etc. Especially if the central banks around the world continue to play the money printing game and destroying the value of cash with inflation and artificially blowing up the price of assets, we will all be much safer having some assets in this future. So why do I recommend this approach to my friends and family? Most importantly, it's easy, and therefore it's achievable, and therefore it's relevant for most people. Of course, more complicated strategies and time-intensive approaches and options and all these tricks to things can be considered by those who wish to, and I will get into that on this channel in future. But for now, I wish to focus on what is appropriate for most people. So by taking this approach of a low-cost investing strategy, dollar cost averaging, you do two very important things. Can you guess what they are? Firstly, and most importantly, you eliminate the ongoing percentage fees from both financial advisors and mutual fund managers, thereby guaranteeing you increase your returns by those saved fees. Likely saving around 2 to 4% annually, which, as I've already shown, has a substantial benefit over 20 to 30 years, and especially with large fund balances. Secondly, and equally important, you continue to invest during ups and downs in the market cycle, ideally adding more during the downs, as what is my favorite quote? Time in the market is what matters more than time in the market. Round of applause for those that are starting to say this quote with me as I say it. Now, if I can, please ask you a favor. I feel this is a really important video, so please share it with your friends and family, as I hope to help change the destruction of so much retirement assets for so many families all around the world, as I know we will all most certainly need it. Thanks for watching. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.